Something happened this morning that hasn't happened since 2007. You can see on the screen behind me that the Treasury yield has inverted for the first time since 2007. A lot of economic things that are coming out this week. Federal Reserve met on Wednesday. Huge implications on what they said, essentially changing their tone from saying, hey, we're going to keep raising interest rates to saying, nope, we're going to keep interest rates the same. And as a matter of fact, we're going to change our strategy on buying back mortgage bonds. And I won't get into that because it's pretty complicated, but the fact of the matter is that was a very, very good sign for mortgages and mortgage rates, and 10-year Treasury rates fell as well. So here's what happened this morning, and here's what inverting of the yield curve means. First and foremost is it means, unfortunately, it's a signal of an impending recession. And so it is the standard indicator that a yield is how much interest is paid over a certain period of time. And you would think that the shorter amount of time that you are borrowing the money, the less interest you're going to pay. And so an inverted yield curve means, no, you're actually paying more interest even though you're borrowing it for a short period of time. And that's exactly what happened this morning. So the 3-month Treasury yield is currently at 2.462%, and the 10-year Treasury yield has fallen and is currently at 2.439%. In other words, if you loan money to the federal government by buying a bond and they're paying you back in 3 months, they're going to pay you 2.46% interest. But if they're paying you back in 10 years, they're going to pay you 2.43% interest. The bigger indicator of what people watch for an inverted yield curve is when the 2-year Treasury gets to be higher than the 10-year Treasury. Right now, the 2-year Treasury is not higher. It's at 2.33. That's the bigger indicator of an impending recession. But the first portion of the yield curve that inverts is a sign that we're going down a road that's going to lead to a recession. We all have known that. We all should be expecting it. It's going to lead to lower interest rates. Over time, it's going to lead to some job reduction, and that's going to create some challenges that happen in the cycles that we expect to have happen repetitively. Here's the part where I was wrong. I was wrong when it comes to what this spring is going to represent relative to home buying and interest rates. I was sure that, and I was still right. See, I'm going to make myself seem right. I was right that if rates had stayed the same, we were not going to see buyers come back to the market. We were going to see housing prices drop pretty significantly. For those who have been watching me do my videos for the last few months, I have been talking significantly about the fact that I think that this spring is going to be a shock and that it's going to be the first drop in the housing market in a while, because sellers were waiting to sell their home until spring, and buyers weren't going to come back in the spring because they were tired of rates being higher. They were tired of getting rejected on their home price, on their home offers. That has changed now. I have had more people get pre-approved this month than I've had any month in the last year, and the month is only 3/4 of the way over. Secondly is if you have buyers who have said, you know what, I'm just going to wait. I want to wait until things settle down or things drop. Now is the time. I'm seeing a lot more multiple offer situations, but there's still a lot of good inventory on the market. If you're aggressive and you want to find that property, get it now before prices go up this spring, because I really feel prices are going up because rates are definitely going down, and that's going to spur buyers back into the market.